In addition to being one of the most influential organizations in the world, Vanguard is an asset manager that has taken the market by storm and has a direct influence on many of the major American tech companies, including Google, Amazon, Microsoft, and many more. Its portfolio of assets is estimated to be worth $8.6 trillion. This video will teach you the history of this financial behemoth and reveal the identity of the people responsible for such a massive enterprise that commands $8.6 trillion. Vanguard owns roughly 8.46% of Microsoft and 7.8% of Apple, 7.91% of voting shares in Alphabet, the company that owns Google, and 6.89% of greater stakes in Amazon. Even in comparison to these holdings and its primary rival BlackRock. In addition, it owns 7.07% of Tesla's shares and 8.7% of ExxonMobil, the largest U.S. oil company. These are just a few of the businesses it is connected to. All of this is done with extreme caution, so the full extent of its investments is not widely known, and the fact that its financiers are unknown contributes to the perception among many that the company is merely a front for some of the most powerful individuals on the planet. This has sparked rumors that the company may be owned by some of the richest families in the world, like the Rothschild family. But what is known is that it all started with the vision of investor John Bogle, who was born on May 8, 1929. The future magnate was born into a wealthy family, but they lost that status a few months later when the 1929 crisis struck, nearly wiping out his father's fortune. His father bemoaned the loss, spending what little remained on alcohol. Bogle learned from his father's downfall that he had to work hard and not expect anything for free, so he started working at a young age and developed the habit of living simply and saving as much money as he could in addition to working. In addition, he excelled academically to the point where Princeton University offered him a full scholarship to study economics. He gained knowledge about the workings of the financial market there, and in 1951, he recognized a promising potential when he discovered a sector of the market that would dominate mutual funds. Even though the industry's assets at the time were only $2 billion, a sizable but insignificant amount in relation to the total assets of the capital market, mutual funds functioned as a team effort in which regular people entrusted their savings to a financial manager in charge of capital management, who knew which assets were the best to purchase. At the time, mutual funds were regarded with great suspicion. In addition, if managed by a fund with a long-term perspective, American investments could provide them with extremely significant returns through a diversified investment mentality in the stocks of the nation's leading companies capable of weathering crises and instabilities in specific sectors. Bogle understood that investing in stocks through mutual funds would be a trend in the coming years, especially as the American economy improved and Americans had a greater appetite for investments. The American people were still recovering from the effects of the 1929 crisis, and they preferred to keep their savings in bank accounts. But also, an offer to get involved in running the Wellington Fund, a mutual fund with headquarters in Malin, Pennsylvania. Walter Morgan oversaw the fund at the time, and it was the sixth biggest in the nation for its kind, with assets of about $150 million. Former trader Morgan sought to recruit people with a similar attitude who would earn money gradually but consistently without being seduced by speculative chances and rapid returns when he created the fund. Morgan had lost nearly all of his money as a trader and had thus developed a defensive strategy to protect his fortune. Nevertheless, in order to reduce market risk and volatility, the Wellington Fund made investments in a variety of financial instruments in addition to equities. John Bogle, who had become a shareholder in the business, decided to take a risk and defy his mentor's vision by creating the Wellington Equity Fund, a fund within the company that held only stocks. This went against Bogle's belief that the stock market held more long-term opportunities than other investments. Nevertheless, over the next 7 years, mutual funds grew tremendously in the U.S., especially because the American economy was booming and nearly doubling its indicators during that period. As Bogle had predicted, however, as the economy improved, ordinary people's risk appetite increased, which meant that the balanced and defensive portfolio of the Wellington Fund no longer attracted the same number of individual investors. Despite the skepticism of his mentor, the fund was a huge success, managing $44 million in assets in the first year alone, returning about 30% for the original investors. This success continued in the following years, maintaining a balanced philosophy of long-term stock investment, which led to Bogle's appointment as CEO and Walter Morgan's successor at the age of 35, making the Wellington Equity Fund the company's main focus. However, as Bogle's personal success grew, he began to face criticism, and his fund lost appeal and clients to other more aggressive funds in the market thriving during a period of prosperity. This left the fund's future uncertain in 1965 and left no other choice. Bogle had to look into merging the company with other funds in the market that were comparable in size. However, no fund of that size was willing to join Wellington, primarily because Bogle's long-term philosophy deviated from market practices. The only other option was to merge with a smaller fund called EIST, which took 40% of the business over the course of the next 8 years in order to integrate its assets. The merger was successful and gave rise to 10 other funds that by 1973 had $3 billion in assets under the company's management. But when the bull is loose, everything appears fine. Unfortunately, the American economy started to confront severe challenges after the oil shock, and the company's portfolio decreased from $3 billion to $1.3 billion. John Bogle was defeated and humiliated in 1974 as a result of this situation, which put him at odds with the previous owners of EIST and resulted in his dismissal from the CEO position. He was then named president of the company, a figurative role in which he was unable to make any decisions regarding the investments of the mutual fund he had founded. But he managed to turn the tables such that he was unable to make investment selections in accordance with the rules. However, he had the authority to make decisions about business management as president, so he chose to innovate in the market. Up until that point, mutual funds were only able to collect money. Financial management was outsourced to an investment manager. The Wellington structure, however, included both the fund and the management company. However, Bogle discovered a way to do away with this middleman and handle all financial operations through a single structure, changing the path of the firm and saving millions of dollars in the process. By law, they couldn't be combined. He made the decision to alter the rules of the game and the company's name, which is now Vanguard. He also introduced the first index fund in history, which is now known as Vanguard 500, which, according to the S&P 500 index, holds shares of the 500 largest companies traded on the American market. The idea for the fund originated from a research study by the renowned economist Paul Samuelson, who in 2005 ranked Bogle's endeavor as an invention on par with the wheel, the alphabet, and Gutenberg's press. Unlike mutual funds, the index fund does not require active management, and because of its simplicity, its operating costs are significantly lower. This allowed investors of all stripes to invest small amounts in the fund, which attracted a very efficient operation. The fund's simplicity was so significant that it was mocked when it was introduced to the market. But by 1982, its assets had already risen to $100 million, and by 1988, they had surpassed $1 billion. Its success was so enormous that in the 1990s, other financial market giants started to imitate many of its phony strategies. In 1995, Bogle retired and handed the reins to Jack Brennan. Bogle himself picked Brennan to be his successor. However, in an attempt to draw in even more investors, they started to heavily invest in sales and marketing, drawing in a number of middle-class Americans. This tactic went against Bogle's wishes, as he thought that heavy advertising could give the impression to regular people that the company was promising quick and easy results, which was at odds with his philosophy. Bogle attempted to re-enter the company's leadership due to this intense debate, but the board decided to keep him out of the day-to-day operations. Vanguard made an even bigger leap without its founder when it completely entered the ETF, exchange-traded fund, market, which grew in popularity in the late 1990s. ETFs for the market are funds that are exchanged on stock exchanges, allowing Vanguards to reach new heights. Bogle thought that the instrument's volatility could be harmful to investors, so this move went against his beliefs as well. Nevertheless, the business went ahead with it, and in 2020, one of Vanguard's funds, the Vanguard Total Stock Market Index ETF, became the first in the world to amass more than $1 trillion in assets. Regretfully, a year prior, John Bogle, who did not agree with the company's direction, passed away at the age of 89. He saw his creation grow into an asset management company with trillions of dollars under its management. In addition, the investor published his investment philosophy in the best-selling book, The Little Book of Common Sense Investing. Without him, the company's clientele and market presence continued to grow. Currently, Tim Buckley, the company's third successor since Bogle's departure, is in charge of the company's expansion. Not only does Buckley dominate the American market, but he also has local operations in England, Australia, and China, as well as working with the government. Due to worries about legal compliance, Vanguard returned roughly $21 billion in managed assets to government clients in China in 2020. The company also manages funds in the U.S. and Australia's pension industries. With so much money under its control, it's difficult to determine the boundaries of its influence or even the extent of its power. To what extent you believe Vanguard's power goes? Share your comments. The story of Vanguard is not just one of financial success, but also of innovation, integrity, and a commitment to the everyday investor. From its humble beginnings in the 1970s to its current status as a titan in the investment world, Vanguard has remained steadfast in its mission to provide low-cost, high-quality investment options for millions of people around the globe. As we look to the future, it's clear that Vanguard's legacy will continue to shape the way we invest for generations to come, making it not just a company, but a cornerstone of financial empowerment for all. In conclusion, investing is a powerful tool for building wealth and securing your financial future. We've covered a wide range of topics in this tutorial series, from understanding the basics of stocks and bonds to mastering advanced investment strategies. Remember, knowledge is key, and the more you educate yourself about investing, the better equipped you'll be to make informed decisions. If you found this video helpful, don't forget to give it a thumbs up, share it with your friends and family, and subscribe to our channel for more valuable content on investing. Together, let's embark on this journey towards financial freedom and success. Thanks for watching.